The Federal Reserve just ran the same play they used to save us in 2008. This time, it didn't bring stability. It triggered the worst inflation in 40 years. That should terrify you, because it means the central bank's playbook isn't just outdated, it's dangerous. When Silicon Valley Bank collapsed in March 2023, Jerome Powell reached for the same emergency tools Ben Bernanke used 15 years earlier. Unlimited deposit guarantees, emergency lending facilities, and quiet promises that taxpayers would absorb any losses. The difference this time was simple. Those tools didn't restore confidence. They destroyed it. This isn't about corruption or incompetence. It is about mathematical reality, the kind you can hide behind press conferences or optimism. In 2008, the Fed performed miracles. They slashed interest rates to zero, printed trillions, and convinced the world that unlimited intervention could rescue capitalism. It worked once. So well, in fact, that people started believing it would work forever. But those weren't miracles. They were withdrawals from the future, prosperity borrowed from tomorrow to survive today. And the bill is finally coming due. Back then, the Fed had a full magazine. Rates sat at 5.25%. The balance sheet was under $1 trillion. Quantitative easing was untested, a nuclear option that shocked the system back to life. Today, we're staring at an empty arsenal. The balance sheet stands above $7.4 trillion. Rates are high enough to hurt debt markets, but too low to kill inflation. Every lever they pull now shakes confidence instead of restoring it. The data tells the story. In 2008, the first round of QE boosted GDP by 0.6%. In 2010, the second round gave 0.4%. By 2012, the third round barely reached 0.1%. Then came COVID. $4.5 trillion printed in just 18 months. The result? 9% inflation for barely 2% growth. Each rescue produced weaker returns, like a patient building tolerance to painkillers. But the side effects remained. Every printed dollar reappeared at your grocery store, your gas station, your rent payment. Inflation became the tax that no one voted for. Interest rates tell the same desperate story. Yes, the Fed can technically cut from 5% back to zero. But cutting in 2026 isn't the same as cutting in 2008. Back then, America owed $10 trillion. Today, it owes $36 trillion, not counting state, local, or corporate debt. So what happens when you slash rates while carrying triple the debt? You don't stimulate growth. You trigger a debt spiral. The medicine has become the poison. Jerome Powell knows this. You can hear it in every press conference, the tone of a man trying to control a fire with a glass of water. The Fed's messaging has changed. They're not managing expectations anymore. They're managing panic. Whenever you hear unconventional tools or new frameworks, don't think innovation. Think confession. It's an admission that the old weapons no longer work. The political landscape makes things even worse. In 2008, Americans hated bailouts, but they accepted them. Too big to fail was still new. People believed it was temporary, not anymore. 15 years later, over 70% of Americans still oppose bank bailouts. Trust in financial institutions has collapsed. Congress can barely agree on a budget, let alone trillion-dollar rescues. The political capital that made 2008 possible is gone. And you can't print trust. In 2008, people believed someone smart was in control. Bernanke, Paulson, Geithner, technocrats who seemed steady. Today, that faith is gone. We watch the Fed call inflation transitory. We watch them raise rates to fight the inflation they caused. We saw banks collapse while officials insisted everything was fine. Every crisis now requires bigger interventions for smaller results. The dot-com crash needed rate cuts. The 2008 collapse needed quantitative easing. COVID needed unlimited money printing and direct government checks. So what comes next? What's bigger than printing $4.5 trillion in 18 months? What's stronger than zero rates and trillion-dollar bailouts? The answer is chilling. Nothing. The Fed knows it. Every central bank knows it. That's why they're inventing new weapons. Digital currencies, yield curve control, direct equity purchases, negative rates. Experiments disguised as innovation. But history has already tested those ideas, and everyone has failed. Japan tried negative rates. The result? Zombie banks and stagnation. Europe bought corporate bonds. The result? Pension crises and asset bubbles. China launched a digital yuan. After 5 years, adoption sits at 0.13%. These aren't solutions. They re-symptoms, the final experiments of a system that has run out of real ammunition. And yet the Fed still insists everything is fine. Treasury officials say the U.S. financial system is the strongest in history. Regulators claim depositors are safe, but their actions tell a different story. When Silicon Valley Bank collapsed, every deposit was guaranteed, instantly. No debate, no vote, no legal process. 3 weeks later, First Republic collapsed. This time, regulators let it fail and sold it to J.P. Morgan. Same crisis, same risk, opposite response. What changed wasn't the economics, it was the politics. That's the real shift happening now. From saving the system to deciding who gets saved. From monetary rescue to financial triage. The next chapter won't be about stabilizing markets. It'll be about choosing winners and losers before the crash even begins. The Federal Reserve's balance sheet tells the whole story. In 2008, it held just $900 billion in assets. Today, it's sitting at $7.4 trillion. That's not growth. That's desperation stretched across 15 years. During COVID alone, the Fed created $4.5 trillion in only 18 months. More money than existed in the entire U.S. banking system before 2008. Think about that scale. And yet, each dollar produced less real impact. Every expansion brought weaker returns and heavier consequences. The first QE bought time. The later ones bought inflation. Your purchasing power became collateral damage. The grocery aisle became the battlefield. The dollar itself became the casualty. Interest rate policy tells the same story of exhaustion. Yes, the Fed can still cut from about 5% to 0 again. But in a world drowning in debt, that lever no longer saves anything. In 2008, slashing rates meant lowering borrowing costs and sparking new credit. In 2026, slashing rates means detonating a mountain of debt obligations that already strain the system. Because every cut now expands risk, it rewards leverage, it punishes saving, and it accelerates the debt spiral that has already begun. Jerome Powell understands this math. That's why his language has changed. Less confidence, more caution, less policy, more pleading. He no longer promises prosperity, he promises stability. But stability built on trillion-dollar deficits is illusion. Meanwhile, the Fed's credibility has evaporated. When they called inflation transitory, markets believed them. When prices kept climbing month after month, that belief shattered. Now, every word from the Fed moves markets in the opposite direction. Traders no longer listen. They react against. According to research from the Bank for International Settlements, forward guidance effectiveness has fallen by 75% since 2020. That means central bankers can't even influence markets with words anymore. They must act. And every action now carries greater risk than reward. International coordination, once the secret weapon of global finance, is dead. In 2008, the world's central banks moved together. They cut rates, opened swap lines, and spoke with one voice. It worked because every economy faced the same disaster. Today, that unity is gone. The Fed fights inflation while Europe fears deflation. China wrestles with a property collapse. Japan is crushed under demographics and endless debt. Currency wars have replaced cooperation. When the Fed raises rates, it strengthens the dollar and strangles emerging markets. When others respond by defending their currencies, global liquidity dries up. The synchronized rescue of 2008 is impossible to repeat. So the Fed looks inward, and the picture grows darker. The collapse of Silicon Valley Bank exposed the illusion of safety. 15 years of regulation and stress tests were supposed to make banking secure. Instead, they concentrated fragility in new places. When SVB fell, depositors didn't lose money, but they learned a brutal lesson. Regional banks are expendable. Only the giants are immortal. The result was predictable. Billions fled small institutions and rushed into the too-big-to-fail banks. According to the Fed's own data, the top 4 banks now hold 45% of all deposits, up from 32% before the collapse. That concentration doesn't make the system safer. It makes it fragile beyond imagination. Because when only a handful of institutions matter, a single crack can shatter everything. Corporate insiders know this. They're not waiting for official warnings. They're cashing out while pretending confidence. Executives announce record share buyback programs to signal strength, while quietly selling their own stock at 4 times the normal pace. It's not faith, it's exit strategy. Sovereign wealth funds see the same writing on the wall. In 2024, they cut equity exposure by 18%, the largest retreat since 2008. They're moving out of paper assets and into tangible ones: gold, real estate, commodities, hard stores of value for a softening currency age. The Fed insists these moves are routine. They aren't. They're preparation. Because deep inside the central bank system, stress test data already maps the coming collapse. The 2024 Fed scenarios assumed unemployment near 10%, GDP down 4%, and commercial real estate prices falling 40%. Those aren't random projections. They're the Fed's own expectations for the next downturn. And here's the telling part. Under those assumptions, most regional banks fail. But the 30 largest banks, the systemically important ones, survive. Barely scratched. Coincidence? No. It's design. The blueprint for selective survival is already written. The rules for who gets rescued and who gets sacrificed exist. They just haven't been activated yet. This is the silent architecture of the new playbook. It's not about restoring balance. It's about preserving control. The Fed knows that the next rescue can't be open-ended. The public won't tolerate it. Congress won't approve it. And the markets won't believe it. So they've built something different. A framework that doesn't require public consent. One that doesn't need new laws or emergency votes. It's already coded into regulation, hidden behind words like resolution authority and systemic protection. The next crisis response will look nothing like 2008. No bailouts on television. No headlines about stimulus. No smiling press conferences. Instead, it'll happen quietly. Behind closed doors. In the middle of the night, while the public sleeps, accounts will freeze. Deposits will be restructured. Losses will be shared. And most people won't realize what happened until it's over. Because this time, the rescue won't come from taxpayers. It'll come from depositors themselves. The term sounds harmless, bail-in authority. But it changes everything. After 2008, lawmakers promised taxpayers would never again pay to rescue failed banks. So in 2010, the Dodd-Frank Act quietly introduced a new mechanism. Instead of bailouts, there would be bail-ins. It sounds technical. It isn't. A bail-in means that when a bank fails, the money used to save it doesn't come from the government. It comes from inside the bank, from creditors, shareholders, and depositors. In plain language, your savings become the rescue fund. Cyprus tested this model in 2013, when its banking system imploded. Depositors with more than 100,000 euros woke up to find their money frozen. Days later, it was converted into bank equity, shares in a bankrupt institution. They lost everything. European officials called it a success because taxpayers weren't charged a dime. The people who lost their life savings probably had a different opinion. But that test wasn't an isolated event. It was the pilot program for a global template. According to the Financial Stability Board, nearly every major economy has now written bail-in authority into law, including the United States. The Federal Deposit Insurance Corporation, the FDIC, holds that authority here. It can convert any uninsured deposits into equity if a bank fails. No vote from Congress, no approval from the president, no warning to the public. The legal power already exists. It just hasn't been used yet. Here's the part most people miss. Only 30 U.S. banks are officially labeled systemically important. These are the giants: J.P. Morgan, Bank of America, Wells Fargo, Citigroup. They're guaranteed rescue in any future collapse. But the other 4,000-plus banks? They're not protected. Their depositors are first in line for the bail-in mechanism. Think about that. If you keep money at a local or regional bank and the next crisis hits, anything above $250,000 can legally be seized and converted into equity. Worthless shares in a dead institution. The FDIC's insurance fund isn't big enough to stop it. It holds about $128 billion. Sounds large, until you remember that U.S. banks hold $17.6 trillion in deposits. That's less than 1% coverage. In a systemic event, when multiple banks fail together, the insurance fund runs dry in hours. Then the bail-in switch flips. Could the FDIC borrow from the Treasury to refill the fund? Yes, but only if Congress approves emergency lending. And we've already seen how fragile that approval has become. So the system works beautifully for isolated failures, but when an entire sector breaks, the protection evaporates. This isn't theory. It's written procedure. And while regulators talk about stability, they're already preparing for selective sacrifice. They've accepted that not every bank will survive, and not every depositor will be saved. That's the hidden framework waiting beneath the next crisis. A system designed not to prevent collapse, but to control it. While bail-in authority handles the sudden failures, the second weapon works more slowly. It's called financial repression. The phrase sounds academic, but it's the oldest trick in the debt management playbook. Here's how it works. Keep interest rates below the inflation rate. Force banks, pension funds, and insurance companies to buy government bonds. Let inflation quietly eat away at the real value of debt. It's a stealth tax. Invisible, gradual, and devastating. Your savings account might earn 4%, but if inflation runs at 5%, you're losing purchasing power every day. Meanwhile, the government borrows at rates cheaper than the decay of its own currency. From 1945 to 1980, this method reduced America's debt-to-GDP ratio by about 4 points per year. Now they're doing it again, just with digital dashboards and softer language. The Federal Reserve doesn't call it repression. They call it yield management. But the effect is identical. Savers lose, borrowers win. And the largest borrower in history, the U.S. government, wins most of all. Corporate America has already adapted. In 2024, share buybacks hit record highs, even as insiders dumped stock faster than ever. They're shrinking the number of outstanding shares to make earnings look stronger, while quietly converting paper wealth into hard assets. It's not confidence, it's exit preparation. Sovereign wealth funds are doing the same. They're selling equities, reducing exposure to Western bonds, and loading up on commodities and gold. They know the pattern. When money loses credibility, tangible assets become lifeboats. Even central banks are hoarding gold again, the same way they did before every major currency reset in history. The last time global reserves spiked this fast was the late 1960s, right before the dollar was severed from gold entirely. The rhythm is repeating. Different faces, same math. Meanwhile, the Federal Reserve keeps pretending everything is under control. They release stress test reports, assure markets of resilience, and congratulate themselves on the soundness of the banking sector. But inside those same reports are assumptions so grim, they border on prophetic. 10% unemployment, GDP down 4%, commercial real estate down 40%. That isn't resilience. That's expectation. And the system has already been arranged for that outcome. The strongest institutions, the giants, will be protected. Everyone else will bear the cost. It's a perfect design for quiet consolidation. When smaller banks fail under pressure, their assets flow upward. Deposits migrate to the giants automatically. Competition dies, and control centralizes. That's not market evolution. That's managed collapse. And when it's done, a handful of banks will dominate everything. The payments, the credit, the data. A structure perfectly suited for the next step of monetary control. Digital currency. That's where this road leads. Because once the system consolidates enough, they won't need thousands of banks. They'll need one network, one ledger, one form of programmable money that can be created, tracked, and deleted at will. The foundations are already being built. And the official promise sounds comforting. A faster, safer, modern payment system. But behind that promise lies the real purpose, control. Central bank digital currencies, CBDCs, are being sold as the future of finance. A revolutionary upgrade to make money faster, safer, and more efficient. But that's only the headline. The real design is far more dangerous. It's about visibility, precision, and control. It's about turning every transaction into data, and every citizen into a potential policy instrument. The Federal Reserve has spent years researching digital dollars. They've published studies, hosted conferences, and promised Congress that a CBDC will give them real-time insight into money flows. They say it will make stimulus faster, credit easier, and fraud harder. But behind the polished language lies a simple truth. It's not ready. The target launch date is around 2028. That means it will arrive after the 2026 crisis that the Fed's own models already anticipate. And even if it were ready tomorrow, there's another problem. It doesn't work. China already tried. They launched the most advanced digital currency in the world, the ECNY. They forced adoption through state-owned companies, integrated it into every major payment platform, and tracked every transaction in real time. After 5 years, usage sits at 0.13%. That's less than one transaction in 1,000. Even in an authoritarian system where the government can mandate behavior, people still reject control money. Now imagine trying to sell that same system to Americans, a public already furious at inflation, surveillance, and bank bailouts. The digital dollar isn't about innovation, it's about control after collapse. Because when the next crisis hits and the old tools fail, when rate cuts, QE, and bailouts no longer work, a digital currency gives the state something new. The ability to target, to direct money not to markets, but to specific people, industries, or regions, to decide who gets liquidity and who doesn't. That's the power the Fed wants. Surgical precision, unlimited visibility, and total compliance. They claim it's about efficiency. But efficiency is just the polite word for control. If your money exists only in digital form, on a government ledger, it can be programmed. It can expire. It can be restricted to certain purchases or geographies. It can be frozen with a single command, and it can be used to enforce policy at the individual level. Imagine a world where stimulus checks appear instantly in your account, but can only be spent within 30 days or only on approved goods. Imagine carbon credits attached to your grocery card, limiting how much you can buy. Imagine taxes deducted automatically, interest rates adjusted per person, and savings penalized if not spent fast enough. That's not the future of freedom. That's the future of control. And once the system is digital, there's no way back. You can't withdraw digital cash. You can't hide it under your mattress. You can't move it without permission. Every transaction becomes a data point. Every data point becomes leverage. And the line between monetary policy and social engineering disappears. Yield curve control, negative rates, digital currencies, they're all parts of the same last resort architecture. A framework built to manage decline, not prosperity. Look at Japan. Since 2016, it has tried to control its bond yields by promising to buy unlimited government debt. Unlimited. The result? A debt-to-GDP ratio over 250%, the highest in the world, and an economy frozen in slow motion. When a central bank becomes the largest buyer of its own government's debt, it stops being a bank. It becomes a shadow government with a printing press. That's the road the Fed is walking now. Because when you can't default and you can't grow, you inflate, you debase, you stretch time with money until confidence breaks. Every empire in history has reached this moment. Rome clipped its silver coins, Spain flooded the world with debased gold, Britain devalued the pound, and America, the empire of credit, is now devaluing trust itself. The pattern is ancient. The tools change, but the outcome never does. The public grows angry. The politicians grow desperate. And the central bankers grow inventive. They promise new frameworks, new technologies, new forms of rescue. But the truth is simpler. They ran out of real options long ago. When you hear officials speak about innovative monetary policy, what they really mean is, we're out of ammunition. When they talk about temporary measures, they mean permanent decline. And when they promise that your deposits are safe, they mean until we need them. The illusion of control will hold. Until it doesn't. And when it breaks, everything tied to it breaks too. Pensions, savings, currencies, confidence, all will reset, not through reform, but through necessity. The coming financial order won't look like 2008. It'll be quieter, more managed, more digital. Instead of public bailouts, we'll see private seizures. Instead of stimulus checks, we'll see programmable credits. Instead of inflation headlines, we'll see gradual erosion masked as stability. The transition won't be announced. It'll happen one regulation at a time, one bank merger at a time, one pilot program at a time. Until one day, the system you trusted no longer exists, replaced by one you never voted for. That's the new playbook. No more miracles, no more rescues, just control. The Fed's arsenal is empty, the old tools are broken, and the experimental ones, digital money, financial repression, and selective bail-ins, are already waiting for activation. When the next crisis hits, they won't need to invent anything. They'll just turn the key. And when they do, your savings won't be your safety net. They'll be the fuel that keeps the system alive for one last cycle. So the question isn't whether the playbook still works. It's whether you're ready for a system that no longer protects you, but uses you to protect itself. Because the next rescue won't save you, it will need you, and by then, it'll already be too late.